let's take the market conversation ahead, get a check of where the markets are headed, what is looking good, and mainly what should your navigation strategy be amid a volatile market like this. We have Mayuresh Joshi, Head of Equity at MarketSmith India, also joining us on the show. And Mayuresh, hi, good afternoon, and thanks for your time today. And give us a sense of just that, right? The kind of volatility that we have once again seeing seeping in the market right now, given the kind of sector churn we've seen, of course, our viewers or anybody rather would be tempted to buy given the fall we've seen. But which sectors are looking good right now, and how do you gauge where the sector churn could be headed next?
Very good afternoon. Now, again, I think the entire emphasis will be on consumption and growth. So I think both the engines in terms of the GST rationalization moves that have largely taken place would reflect in better volumes happening across both consumer durables as well as consumer discretionary. And at the same time, the government capex along with private capex, which has seen green shoots of coming back, would largely mean that growth capital might be required for a whole host of domestic projects as far as manufacturing or infrastructure growth is concerned. Therefore, we remain extremely optimistic in terms of quite a few segments within all these spaces that can continue doing well. Within consumption as a basket, our own sense is hotels as a space should continue doing well. FMCG selectively, where volume/value growth should emerge very, very strongly, should emerge as a very strong earnings contender, where earnings should come back very, very strongly as we start hitting Q3. Within the subsegments of consumption, footwear and domestic apparel makers might actually continue doing well. Since infrastructure manufacturing, because of private and public capex, might be also something on the agenda, I think select NBFCs can continue doing well, in our opinion. For infrastructure and manufacturing, I think the sub-segments like cement, where the expectations of reasonable volume growth coming through, consolidation that we've probably seen for the industry itself will mean better dynamics as far as pricing is concerned, because of a lot of cost efficiencies built in because of internal power, captive power uses as wastage recovery plants as well, along with more sanguine logistic requirements that have got built in, along with cheaper input costs. Reported EBITDA and EBITDA per ton as we head into Q3 will be relatively better. So in our own sense, I think selective sectors, as I mentioned, can continue doing well. And again, I think the entire focus in terms of both consumption and investments coming back might actually propel earnings to probably hold up as we begin Q3. Therefore, from a market standpoint, as we see it in MarketSmith India as well, the distribution day count is at 1. And therefore, I think as numbers start improving in Q2 will always be a little bit soft because of the monsoons and the seasonal weak quarter that is always expected. But commentaries might hint to better numbers coming through Q3 onwards, which will give the much needed impetus for the markets. And in all probabilities, if we remain in a confirmed uptrend, we might actually hit all-time highs before we end this campaign.
So Mayuresh, taking this GST conversation ahead, we've been talking to a lot of white code managements and consumer durable companies, and they're optimistic that this GST cut could make up for the kind of losses they've seen due to the early monsoons. Do you think that is something that could be possible, or how long do you think GST benefits would take to start showing up as positives in the company financials?
Of course, I think most managements are alluding to the fact that an evident volume picture will be only visible in Q3. And thereafter, I think it all really depends on how the demand dynamics stick up. Having said that, I think in terms of consumer durables, and structurally, I think if you really look at white goods as a segment, they're talking about ACs, refrigerators, washing machines, microwaves as an example. I think that entire ecosystem might see some element of growth coming through. And that might be prima facie in terms of urban and semi-urban areas, where a large part of this growth will come through. The income tax rationalization which has happened, which will again start paying out very, very effectively. With GST rationalization coming through, I think there will be an added incentive to probably go out there and spend. And therefore, I think a lot of management seem very, very optimistic. And therefore, I think visible results will only be seen probably in Q3. Having said that, I think the expectation largely in terms of how much of an impact can it create in terms of volumes, and therefore all our numbers when it comes to top line, including margin expansion and bottom line growth. I think Q3 will be a base factor. Having said that, again, I think Blue Star is something from the AC segment which has done well. A proxy to this might also become something like an Avils, which can probably have some element of say both in terms of durables as well as creating the necessary impetus that it probably carries through in terms of its core business.
But along with that, Mayuresh, just wanted to have your take on select exchange-related counters. Of late, they have been very volatile on the back of the kind of news flow and the F&O adjustments, how the volumes are expected to get a hit. But what's your sense on the exchange-related counters as of now, Mayuresh?
Well, Srishti, I think you'll have to give it time, right? Because I think with all the regulatory changes that are now transpiring as we speak, it really depends, and it's to be seen what kind of an impact does that really have in terms of the overall volumes as far as these exchanges are concerned, both BSE and the data that we'll get from NSE as well. And therefore, I think equity linked exchanges might actually have some element of softness embedded in Q2. Based on all these factors put together. And what does the consultation paper actually tell us in terms of weekly expiries, whether it's going to be fortnightly expiries looking forward? I think nobody's sure about that. So I think wait and watch on that. In fact, out of the exchanges, MCX in terms of ratings and rankings probably looks a little bit better placed. The expectation in terms of more contracts coming through MCX way might actually pave way for more stability in earnings as we speak. The gold and silver futures, which have probably got launched, options, which is still a large part in terms of the average daily turnover. The balance sheet probably looks very, very strong. They've got very strong EBITDA margins as we speak, in excess of 71%. And therefore, I think more institutional participation as one reads through in terms of the commodity exchange, the kind of leadership that the stock probably carries as far as a large part of the contracts are concerned, whether it's gold, silver, crude, natural gas, which becomes a more important and a prominent part in terms of their average daily volumes, might actually mean that if all these initiatives are taken up, it might mean better volumes and margins will probably sustain, which means better bottom line growth. So out of all the exchanges at this juncture, MCX probably seems to be a tad bit better placed.